Here we go. We have this $1,200 put again that we had featured originally. However, at the time that we were talking about this, there was about 30-some thousand contracts. They added 25,000 contracts going into the closing bell on a December $1,200 put on the S&P. That's roughly $302 million in that 1,200 put. Now, when I go to the 1,205 put, you can see there was 11,000 traded right here. You can see that the high was $60.60 and the low was 54. Huge, huge, huge bets. And you can clearly see here on the chart that this one looks a little different than the other. It doesn't have that many contracts ever traded. They were up here written at 110, but then they dropped them down to the lows here on this particular contract to $54. That's on the 1,205 put. Now, if you take the 1,205 and then you get right back over here to the 1,210 put, you can see, and they're all relatively within the same price. Let's take a look at the 1,210 put here as well. And once again, unlike the 1,205, they look fairly similar down here on those two in the chart here. So the total value between the 1,200, the 1,205, and the 1,210 would be a whopping $750 million between those three combined strike prices that the big money is betting on a huge collapse going into year end between now and the end of the strike of the calendar of 2011 period. We're going to be monitoring this very carefully because a couple of things can happen. We could rally higher, but the big money is paying huge money to hedge their portfolios because of the austerity in Greece, Portugal, Spain, Italy, and Spain being the two biggest, and then you got the Germans, and then you have the Russian people there, and they're trying to come to a great deal on what they're going to do. So basically, we got huge, huge amounts of cash going into the short side of the end of 2011 period. That means that that big money believes that the S&P is done going higher, otherwise you wouldn't see the volume. Once again, I'll recap it. 1,210 put, 15,000 contracts. That's a lot of contracts, irrespectively. The 1,205, once again, 11,000 contracts, 52 by 54. Once again, the biggest strike is 55,000 put contracts purchased on the 1,200 with the combined value of roughly right around $750 million. And you can see that the December expiration calendar year, expiration monthly, you can see here that they were up here at $150. Well, they're getting $100 savings. No wonder they're buying that big bet, because when the S&P was selling off before we had the rally over the last couple of weeks, they went from 150 down here. So I can't say it's stupid money. I can say it is smart money. If I'm buying 55,000 contracts at $100 a less contract, the big money is saving $100 a contract. That comes out to over $550 million in savings on their purchase. So I can't say that they're doing the wrong thing. What I can say is that they're hedging the calendar year end at one big cost savings compared to where they were up here at the highs. Okay, and the last time we got down to these lows over here, which was at $38 a contract, we went from $38 a contract on the $1,200 put. When we went down to $10.75 on the S&P, they peaked at a whopping $151. $151. We were involved in some of the other contracts that were in September and October that we had taken and already cashed in. Big money is smart today.